Good morning. I'm Sudarshini, and today I'll be discussing about one of the most important economic problems that India is currently facing, which is the bank loan growth slowdown. India is currently experiencing a notable deceleration in the credit expansion, which has significant implications for the businesses, the consumer, and the overall economy. Now we'll be understanding more about the issue. And for that, we'll delve into a concept known as bank credit. We know that bank credit is a critical driver of economic activity, supporting investments, consumer spending, and business growth. However, as of early 2025, India's bank loan growth has slowed down for the eighth consecutive month. Year on year, loan growth has dropped to around 12% to sharp decline of 16.6%, which was recorded last year. Apart from the HDFC Bank merger, the Action loan growth is even lower, which is 11%, which was comparatively to last year, which was 20.5%. Now, why is this a concern? Why is this decline something that should be bothering us and problematic? It's because the credit expansion is directly linked to economic growth. Slower loan growth signals a contraction in investment and spending, which can dampen the GDP growth rate. What are some of the contributing factors that can be linked to the slowdown? The first one is the regulatory measures. The RBI had introduced stricter capital requirements in late 2023, targeting personal loans, credit card loans, and the loans to NBFCs. The second one is the liquidity constraints. Banks are facing rising deposit costs, making it expensive for them to lend. A significant portion of this liquidity is being absorbed by government borrowings. The third one is economic uncertainty. Global economic uncertainty and domestic challenges have made businesses and individuals more cautious, weakening the demand for credit. What are the implications of the slowdown? There are several negative impact effects of this of the Indian on the Indian economy because of this bank loan growth. The first one is reduced business expansion. A slowdown in this lending can lead to stagnation in major industries like manufacturing, construction, and services. The second one is lower consumer spending. A credit crunch will obviously lead to a weaker demand, and this directly affects industries like automobiles, real estate, and consumer goods. There's a risk of slower GDP growth. As mentioned earlier, a persistent slowdown in loan growth can negatively impact India's overall GDP trajectory levels, reducing the employment opportunities and the income levels. What are some of the measures that can be taken to address this issue? First, RBI should evaluate the impact of its recent regulations on the loan growth and consider relaxing some of the capital requirements. The second one is that the government can enhance the banking liquidity, and RBI should introduce some liquidity enhancing measures so that banks have sufficient funds to lend. The third and the final one is that banks should introduce attractive fixed deposit schemes with higher interest rates to boost long term savings. What are the barriers to implementation of the same? Is that first and foremost, there can be regulatory hesitancy because RBI might be reluctant to relax the capital norms too quickly over concerns of financial stability. The second one can be global economic risks. External conditions always remain volatile, and hence India's loan growth revival could take longer than expected for the same. The third one is that people and businesses must feel confident about borrowing and investing again. And merely increasing liquidity won't be enough. And hence, boosting consumer and business confidence is also important. Thank you.